Hello, this is a video created for Dr. Hall, Dr. Thompson, Dr. West, and Dr. Young. This is an overview of my dissertation, and my hope is to add as much clarity as possible and aid your task of working through what is actually a very lengthy dissertation. So this video will be high level. I actually did a video like this for Dr. Cradle a month and a half ago, and he actually said that he started falling asleep in the middle of it. So I'm going to try to keep it succinct, clear, and as exciting as possible. So I'm going to share my screen. All right, so, okay. All right, so here is my dissertation, which you have a copy of. I will start at the abstract. And I'll go over this in a little more detail, and then I'll get high level with the rest of the points. So the value of information content in IFRS financial statements. What is valuable information content? Well, that means that the financial statements contain metrics that are correlated with price and or are useful to investors. Financial statements that are able to do that are said to have a high value of information content. So I use that method or those methods of studying information content on IFRS financial statements. What does my dissertation do? So this abstract explains that IFRS is used in the vast majority of the world. The results have been impressive in terms of both market outcomes and direct accounting measures, with some caveats, which I will explain. This dissertation looks very closely at the Japanese markets and compares firms that use IFRS in Japan versus firms that use Japanese GAAP in Japan. Japan is essentially the only developed market where there's a large number of companies that use both IFRS and a local accounting standard. This is a recent development, just over the last 10 years, and the number of IFRS firms in Japan has grown slowly. Perhaps because of the recency, there's been essentially no testing of the empirical results comparing firms that use IFRS versus firms that use Japanese GAAP in Japan, representing a critical gap in the literature. How is this value of information content going to be tested? Well, it's going to be based on the work of William Beaver, 1968, Ball and Brown, 1968. These are the two initial studies that showed that there was valuable information content in financial statements. And these studies are largely used in the same form as 1968. They're largely used in that form today. The results of these studies, well, based on the Beaver methodology, which tests trading volume. So earnings announcement comes out. What is the trading volume reaction? If the trading volume reaction is more significant for one set of financial statements versus another, then we could say that that accounting standard has higher value of information content. The results of the Beaver methodology show superiority of IFRS firms. This is rigorous to test further analysis of median and skew. Furthermore, there is regression analysis conducted with the Beaver method, which controls for variables such as company size, analyst following, and other factors found to be important in previous literature. The testing based on Ball and Brown is a different type of tests that looks at earnings 12 months prior to the earnings announcements and compares that to price changes over that time period. And that was the significant contribution from Ball and Brown. They said, well, there may not be a price reaction at earnings announcement, but if you look back 12 months, you will see the correlation. Based on that methodology, this dissertation finds a stronger correlation for IFRS firms compared to Japanese GAAP firms. Results are enhanced by a close analysis of the proper method of specifying surprise earnings. So if the earnings number, if the financial statements contain value, then it is the surprising information in financial statements that contains value, surprising in terms of over the whole 12-month period. So how do you measure surprising earnings? Well, there are various ways used, and a deeper analysis of that strengthens the results of the Ball and Brown tests. However, the Ball and Brown tests do not withstand analysis of a bootstrapping procedure, which is an attempt to say, well, okay, the IFRS firms in Japan have stronger correlation metrics, but is that statistically significant? Turns out there are not a lot of clear ways to do that. One is this bootstrapping procedure, and the confidence intervals in this case overlap, and this dissertation cannot make the conclusion of a statistically significant difference. But that is not a huge limitation of the dissertation, because most of the studies use just higher correlation metrics to suggest a superiority of one accounting standard over the other. And this result is presented with a whole mosaic of evidence of variations of the Ball and Brown test methodologies and the Beaver methodology, and of course the literature. Sample data in Japan, Nikkei 225, found to be representative of the Japanese economy. Furthermore, the samples within the Nikkei 225 are found to be strong comparisons, strongly representative. The subsamples within the Nikkei 225 of each accounting standard are found to be comparative to the overall Nikkei 225 index. All right. This result is the first known empirical test comparing the current standards in Japan, possibly because of the recency. There's essentially no literature testing this accounting experiment. There are a variety of studies testing the expectations and discussing the expectations, but there are no tests of the results. Key limitation, voluntary adopters of IFRS. So these studies that are tested chose IFRS voluntarily. So that is a limitation that I must admit in the dissertation. And I will explain why the result still is considerably valuable, even with that limitation. One additional noteworthy result is the method of surprise earnings calculation based on a qualitative categorization of analyst expectations. So I classify this surprise earnings with several different variables. One of them is a qualitative variable. Did the companies beat expectations or miss expectations? And expectations were based on my data source, Bloomberg, which that particular variable was shown to be one of the strongest correlations throughout this testing. That is potentially an additional contribution of this dissertation. Okay, so that is the abstract. Let me go to my table of contents. I've got my dedication, acknowledgements. All right, so table of contents I think is very helpful as you pick through this. And I've got all of these headings and subheadings marked in the dissertation. So you can actually put a navigation tab if you go to View, Sidebar, Navigation. All right, and we've got all this headings and subheadings. I like to go do a right click, click on one of them, do a right click, show heading 1. So that's View, Sidebar, Navigation. I took it off. View, Sidebar, Navigation. Okay, and then right click, I like to go to heading 1, and then I can expand them as I go through. So I think if you understand the abstract and understand how to use this navigation tab, you should be in good shape of picking your way through and focusing on areas that you want to read more or less, and also just understanding how everything is presented. So with the various levels of headings and subheadings. So with that, let me do a higher level overview. So chapter 1 is introduction. What do each of these sections talk about? Overview of IFRS, what's going on with the world proliferation of IFRS, common usage, impressive outcomes. There is a brief overview of the history of IFRS in Japan. Japan was considering mandatory adoption, was on a path of convergence, but then paused, stopped that path of convergence, and remains allowing companies to voluntarily use IFRS. IFRS in Japan and the need for testing. So as I mentioned, this is a very new development, and there's been very little empirical testing. In fact, no empirical testing on the actual results. There's been empirical testing on the expectations, and there's been some empirical testing on information content in Japanese financial statements, but none comparing companies that use IFRS versus companies that use Japanese GAAP. All right, overview of the importance of the value of information content. So this is just a warm-up of the two seminal studies, William Beaver, 1968, Ball and Brown, 1968, who showed that accounting statements have value. It's really interesting, I think, to think about how before 1968, accounting scholars said there's essentially no value in accounting statements. It's just heterogeneous metrics that are added up subjectively by the preparers of the financial statements that don't correlate with the actual company value. Ball and Brown and William Beaver changed all that. All right, and the introduction closes with an overview of the dissertation sections, which I am going to give you an overview right now. All right, so that's chapter 1. Chapter 2, literature review. Okay, overview of literature review. First part of, or the first real section, overview of IFRS characteristics. So what are the benefits, one standard and other benefits? Comparability, quality, trust. What are the drawbacks? Control, flexibility, quality. You'll notice that quality is listed as both a benefit and a drawback. Flexibility also could be listed as both a benefit and a drawback. So some discussion on all of that there. IFRS and Japanese GAAP accounting characteristics. So this goes into detail about the specific characteristics and differences of IFRS versus Japanese GAAP. And the thinking here is that if there are only a few differences that the accounting or the academic scholars have commented on, well, there are only a few differences, but also only a few differences that the accounting scholars have commented on. Could we say that those are driving the difference in the value of information content? It's a hard question to solve, but I discussed that possibility. So perhaps we could claim that it's the differences themselves that are driving the differences in information content. Or if the accounting statements, Japanese GAAP and IFRS are similar, then the higher value of information content is going to be an investor preference for one accounting standard over the other. What are those differences? Okay, so there's 3 that are discussed in this section as important in the scholarly work or the literary work. One is the fair value adjustment. So IFRS allows fair value adjustments, Japanese GAAP does not. That's the one that receives the most attention. Another one that receives a little bit of attention is the treatment of goodwill. So Japanese GAAP amortizes goodwill. IFRS does not necessarily amortize goodwill. Japanese GAAP makes the more conservative choice. IFRS makes a choice that is more flexible, but could in reality be more accurate. And then there's a third point about the different treatments of R&D, which is kind of similar to goodwill. Japanese GAAP makes a conservative choice, and IFRS makes a choice that could theoretically be more accurate. All right, so what's next? So that's overview of IFRS characteristics. Literature review then goes on to a full review of all the contemporary IFRS literature. So this is an awfully lengthy section, and the literature findings of IFRS are going to indicate an overall superiority of IFRS compared to various versions of local GAAP. All right, how is that proved? Well, I'm going to show you the studies that say that in a moment. Before I go into that, there's a short statement on US GAAP, essentially saying that comparisons between US GAAP and IFRS are rare, could be a promising area of future research, but there's just a very limited number of those studies. So, and they are included and discussed, but that is one area that where the literature does not make a conclusion. It does not say that IFRS or US GAAP is better. All right, so what are the overall statements, overall findings of superiority? There are a number of meta-studies. I guess there's really just one meta-study. The first one, DeGeorge, Lee, and Shivakumar, 2016, which looks at a whole array of literature and finds that the preponderance of the literature finds superior outcomes for IFRS, for market variables, and direct accounting measure variables, and goes into the details of a number of studies. Other studies reviewed will look at a whole list of countries and say on these 20, 30, 40 countries, the overall findings indicates an IFRS superiority. And other studies reviewed look at individual cases, individual countries adopting IFRS. So the case is made for IFRS superiority in this section. Now, what about the studies that say IFRS is inferior, all right, that we have worse outcomes after a country adopts IFRS? Well, those studies are assessed in this section, findings of inferiority, findings of IFRS inferiority explained. So they are categorized in terms of why they may have produced that finding of IFRS inferiority. If we're going to assume that IFRS is superior, then we have to think about, well, why did these other studies show the opposite conclusion? Well, some of them can be categorized as lack of familiarity. So they were tested in a market where the investors weren't familiar with IFRS. Some of them can be explained by enforcement. So IFRS was introduced into a certain country, but the enforcement measures were not strong in that country. So perhaps investors took advantage of the flexibility of IFRS. A third category is mandatory adoption. So if the whole country was, well, I guess we'll say if there was voluntary adoption, then you would think that only firms who think there's going to be a benefit to IFRS are going to adopt IFRS. So of course you would say that's going to result in a positive outcome. But what if there's a mandatory adoption? Every company in the whole country is required. Well, there's a number of studies that show that can result in negative outcomes. So these, I would say, are significant gaps in if you're going to make the conclusion that IFRS is superior, you're going to have to explain these three things: familiarity, enforcement, and mandatory adoption. So I go into the studies and look at the details of those studies, but I conclude that these are three gaps. And a third gap is, a fourth gap would of course be the gap of literature in Japan, because it's such a new development. All right, so I go into each of these, just kind of explain the various studies, look at enforcement, some different nuances of enforcement, look at mandatory adoption, studies that find mandatory adoption, or the studies that study mandatory adoption and the results there. All right, and then I move into the two research steps in this dissertation. So I ultimately get to Japan and study the comparison in Japan. There is preliminary research in the United Kingdom, so testing mandatory IFRS adoption in the United Kingdom. So in 2005, the United Kingdom, along with the rest of the EU, mandatorily adopted IFRS. And so this being one of the three critical gaps in the IFRS literature, mandatory adoption, I started by testing IFRS. So in the and I'll explain those results when we get to it, but in this point in the literature review, it just explains the need and explains the testing variables, the UK, the use of the FTSE 350 for a testing for a sample, and then a comparison group of the S&P 500 index to account for changes over time. So this was the first step, which ultimately is not going to provide the basis of the dissertation, but it is a first step. And then the second step is the accounting research in Japan. So I go into much more detail because those are the results I rely on to create this dissertation. So the literature review provides everything that's necessary to build the methodology. Talks about characteristics of the Japanese economy, export-based economy. Some interesting comments about the development of the Japanese economy since after World War II and the phenomenal growth in manufacturing industries, and also the equally astounding stagnation since the early 1990s, and some of the ways the Japanese economy has tried to evolve and some of the problems that are still being faced in the Japanese economy. And then in my conclusion, there is the suggestion that the policymakers in Japan are certainly considering various accounting standards as ways in terms of how they would or would not stimulate the Japanese economy. All right, so the Tokyo Stock Exchange, I initially used the Tokyo Stock Exchange as sample data, so I explain why that is a valid way to test IFRS. I go into details of the Nikkei 225, seen as a barometer of the Japanese economy, and also the stocks, the companies on the Nikkei 225 meet very specific characteristics, and those specific characteristics lend themselves to a strong sample comparison. So if I take one group of Nikkei 225 firms and compare it to another group of Nikkei 25 firms, I can at least be assured that they are similar on metrics such as company size, shares outstanding, and a few details such as that. All right, IFRS experiment in Japan. So this goes into detail about how this discussion with IFRS progressed, some details on the regulatory structure of Japanese accounting, which is important because IFRS does not enforce Japanese accounting standards in Japan. So all the enforcement regulatory structures in Japan are critical, and the literature below is going to describe these governing bodies. So there's a brief definition of all of those. The actual steps to convergence. Japan was considering mandatory adoption, was on a path to convergence, stopped that path of convergence, and decided to allow voluntary adoption. Benefits of adoption. Okay, so these sections, we have benefits of adoption, we have expected beneficiaries. So what are the benefits of adoption? Who specifically, what kind of companies might be expected to benefit? Some market evidence of these benefits, and of course, some drawbacks. So what are the benefits of adoption? Comparability, quality, trust, some discussion on that, and some debate on that in the Japanese literature. Expected beneficiaries. All right, so no surprise here. We've got expected beneficiaries are firms that have higher percentage of foreign shareholders, more motivated to share information with investors or potential investors. Market benefits. So this has been pretty much the empirical study on this topic in Japan, is what is the market reaction when firms announce that they are going to adopt IFRS? And the expectations are positive. Increased stock prices when firms announce adoption. What are the drawbacks? All right, most of the drawbacks, manufacturing companies. Manufacturing companies were particularly concerned with the fair value options in Japan and the fluctuation of asset prices. Many of the Japanese policymakers were reluctant to use a standard with so much flexibility as IFRS. And many of the companies that became comfortable with the clear guidelines in Japanese GAAP and the lack of flexibility in Japanese GAAP expressed ambivalence to moving to IFRS. Okay, so then next in the lit review, there is a more complete review of the IFRS literature in Japan. Now, this is just a more detailed explanation of everything that is covered in the IFRS experiment in Japan. These sections above, the Japan IFRS literature review, these individual studies are where that information comes from. It was important for me to do. You may want to skim through it, or perhaps as you see things that are related in the sections above, there's deeper reading in each of these studies. All right, so that's Japan. All right, so now let's talk about the testing methodologies. All right, what are the testing methodologies we are going to use? Well, there are two. There's Ball and Brown, 1968, and there's William Beaver, 1968. This dissertation uses the contemporary adaptations of these two testing methodologies that are remarkably similar to the original tests in 1968. So Ball and Brown, a lot of detail here. It was important for me to do all this research. Looking at the original Ball and Brown study in 1968, there was a reflective piece in 2014, and there were a bunch of studies that followed Ball and Brown. I review them. I go into a lot of detail of these studies. Like I mentioned, it was very important for me to understand the proper methodology and understand, yeah, that's it. It's the proper methodology, how to justify my conclusions, how to conduct these tests. But may not be as necessary for you to go into as much detail in reading or understanding. Of course, I'm available to discuss any of those as necessary. Contemporary use of Ball and Brown. All right, so what are the contemporary uses of Ball and Brown? Well, contemporary use have mainly developed into regression analysis. I mentioned, I think at the start of this video, that Ball and Brown is comparing earnings and price. Specifically, it's comparing surprise earnings. So what about the earnings? What about the earnings announcement is surprising? And let's compare that to the changes in price over the previous 12 months. Now, it may not be surprising on earnings announcement day because all of that information has become known over the previous 12 months. So let's do a regression analysis over that previous 12 months. What are some of the easier methodological choices in conducting that methodology? That would be using abnormal stock returns based on a market model and using annual earnings announcements. There was some support for quarterly earnings announcements, but annual earnings announcements have the most support. So those are a couple things that are easy about this regression methodology with Ball and Brown. There's a couple things that are more difficult. Determining the valuable component of reported income. So what is the surprising component of earnings? Well, is it just the number, the raw number? Well, no. I mean, a firm could have increased earnings by 10% since the previous year, but that doesn't mean anything because if the whole industry or the whole market had a phenomenal year and most companies increased earnings by 20%, then actually the firm underperformed. So there's got to be a way of specifying the expectations and the surprising information. And there's a high amount of literature support for specific income expectations. Ball and Brown attempted to get as specific as they could. This dissertation uses analyst expectations to get those specific income expectations. There's also some support for some drift adjusted models. Just, you know, without getting too specified in trying to say you know more than you know with the earnings expectations, some studies have found just a drift adjustment in earnings is the best way to quantify what is the surprising amount of earnings. Most of the contemporary literature uses magnitude variables. So that's, did earnings increase by 2%, 4%, 5% above what we expected them based on our expectations of earnings. Some of the studies though, actually no, I'll take that. Pretty much all the contemporary studies use magnitude variables. However, the original Ball and Brown used qualitative variables. It was, did this company beat expectations or miss expectations? So a yes/no qualitative question. That's what Ball and Brown used. I used that in this dissertation, but I expected the magnitude variables to have the highest correlations to price. Turns out in this dissertation research that the qualitative variables had much higher correlations and were much more consistent, which is an interesting finding in this dissertation work. All right, so we're still on Ball and Brown and we're assessing meaningful differences. Okay, so Japanese GAAP has a correlation metric of 0.3. IFRS has a correlation metric of 0.4. All right, so the companies that use IFRS are more closely correlated in terms of earnings or surprise earnings and price. Is that difference between 0.3 and 0.4 meaningful? Well, many, as I mentioned in the abstract, many of the studies simply say that a higher R or R squared correlation coefficient or coefficient of determination, higher R or R squared, is going to indicate and is going to suggest superiority. And that's how a number of these studies conclude. There are some studies that try to go into more rigorous measures of proving that. Really, the only one that is mentioned even more than once is a bootstrapping method, which is a method of resampling and trying to develop a confidence interval for these correlation metrics and determining whether or not the confidence intervals overlap. There are a couple other methods that I go into that are mentioned just once, but essentially there doesn't seem to be a clear way of proving a statistical superiority of the correlation of one accounting metric versus the correlation of another accounting metric. Bootstrapping, like I said, is the only one that's even mentioned more than once, and I do construct a bootstrapping methodology. All right, so last section on Beaver is this assessing small or less effects. So this is the idea that if the correlation between surprise earnings and price is small, meaning a correlation metric of 0.1 or 0.2, is that significant? Is that worthwhile? Now, if Dr. Sharad Maheshwari is in my dissertation defense, I think he might raise his hand and say, well, any correlation metric below 0.4 is really not that meaningful. And most of my correlation metrics are below 0.4. So I have to make a case of why that is a noteworthy result. And the case is as follows, that there has been a long-standing understanding, a proof of the relationship between earnings and price. But it has always been understood that the effect of the correlation between earnings and price is small. Before 1968, people thought that there wasn't even a correlation between these two metrics. After 1968, accounting professionals, research scholars said, yes, there is a correlation and it's there. And it has been consistently studied and shown to be there, but it's always been small. It's always been correlation metrics in the 0.1, 0.2 range. And so that analysis is provided in that section. Okay, so that is Ball and Brown. William Beaver. All right, so let's go over the literature for William Beaver, the original study. I go into a lot of detail here. I was proofreading this the other day and realized just how much detail I went into. It was important for me Some of it you may want to skim through quickly. Contemporary use of William Beaver. Well, all right, so William Beaver's trading volume. So when there's an earnings announcement, if there's a trading volume reaction, that indicates that the information was valuable. Beaver, and I'll explain kind of more of the premises of that in a minute. So it's trading volume for William Beaver. That has evolved into two different contemporary methodologies. One is just the mean difference of trading volume. So we would look at the trading volume of companies that use IFRS, compare it to the trading volume of the companies that use Japanese GAAP. If the trading volume of the companies that use IFRS is higher, and statistically so, then we could say that we have, by that metric, higher, more valuable information content. And so that's contemporary use of mean difference methodologies. The second contemporary use of William Beaver is regression analysis. So this would be trading volume as a dependent variable. And then we would have IFRS adoption, a qualitative yes/no IFRS adoption, as an independent variable. And we would also have a variety of other control factors as independent variables. Company size, shares outstanding, things that need to be controlled for so we can isolate the effect of IFRS. And with the regression analysis, the interpretation is if this qualitative IFRS variable is statistically significant, then we can say it makes a statistically significant difference in trading volume. And if that is a positive difference, then we would say we have evidence of superiority of IFRS. All right, the one thing about, and I'll mention about this Beaver methodology, is the assumption of divergent investor opinions. So what makes the Beaver methodology work is that investors have different opinions. So the overall consensus price may not change on announcement day, but individual investors will have a different way of interpreting that information. They'll have different risk preferences, different processing capabilities. So they will find value in that information, and you will see a trading volume reaction. The one important note is that when we're testing trading volume, and we're making statements about one accounting standard being better than the other, we need to control for investor differences. So if we're comparing two completely different groups of investors, then the comparison doesn't work. So we need to control for investor differences, which are done in this dissertation. All right, so we've got the contemporary support for trading volume, mean difference, and contemporary support for regression analysis. This last section on Beaver closes out statistical significance with multiple independent variables. This goes into what is the appropriate significance level when we're trying to determine the statistical significance of the IFRS independent variable. Is it 1%, 5%, 10%? We prefer 1%. 5% is second best. 10%, there can be a case made for 10% if that particular result fits in with a whole mosaic of supporting evidence, and if the risk of a type 1 error is small. And this dissertation will make a case that the risk of a type 1 error is small. The type 1 error in this dissertation would be erroneously concluding that there's a superiority of IFRS. But if all the literature and all the other tests suggest that that is true, that IFRS is superior, and we have one or two tests that have p-values just under 10%, then there certainly can be a reasonable case made that a significance level of 10% can be used to support that analysis. Okay, so that is the literature review. Methodology. Okay, so we're using all the methodologies that were discussed and explained in the literature review. We've got this Beaver mean difference. So the trading volume comparison, IFRS companies versus Japanese GAAP companies. We're going to do Beaver regression analysis. For Ball and Brown, I did not mention this Ball and Brown classic ratio. So this is essentially exactly what Ball and Brown did in 1968. It's not commonly used anymore, and I'll explain that in a minute when I get to it. But I test it initially to see if it can give me results. And of course, we're going to do the Ball and Brown contemporary adaptations. Sample data, we're going to go start in the UK for some preliminary analysis, end up in Japan. Data source is going to be Bloomberg. So let me just explain each of these testing methodologies, or at least the highlights, in a little more detail. So the Beaver mean difference. So it's actually a trading volume ratio. So it's a ratio of earnings announcement trading volume divided by non-event period trading volume. There's literature support for this. There's a hypothesis. If we have a statistical difference between one accounting standard versus the other, then we can make a conclusion of superiority for that accounting standard. As long as we control for investor differences. Okay, so that's Beaver mean difference. That is commonly used. Beaver mean difference is still commonly used. What is also commonly used is the contemporary adaptation of the Beaver analysis, which is this regression with the trading volume ratio as the dependent variable and with an IFRS qualitative variable as the independent variable and a number of control variables. Simple regression, we'll start with simple regression. That's going to give us the same result as mean difference. And then, but also that's going to give us some performance measures, R and R squared. And then multiple regression analysis with control variables. Of course, I've talked about the hypothesis and the interpretation. Okay, Ball and Brown classic ratio. So this was interesting. This, when I saw what Ball and Brown did initially, I was intrigued. They have a way of what they call the percent of information that is contained in financial statements. And for one of their metrics, they say 49%. So they say 49% of all the market information is contained in the income statement, even the profit number. And I tried to use that on the sample data in this dissertation. The reason I tried to use that is because no one in the contemporary literature ever criticized that. And everyone in the contemporary literature supported the conclusions of Ball and Brown. But also another interesting thing is no one in the contemporary literature ever used that metric. So I thought, okay, well, no one has used it. Let me go back and use the old Ball and Brown method. It turns out there was a good reason no one ever used it, because it just wasn't statistically rigorous. And the first time I tried to test it in the preliminary research in the United Kingdom, it's just a wild fluctuation that even goes negative sometime. So that was an interesting experiment I do for just the one. All right, where am I? And then Ball and Brown contemporary adaptations. So we need to think about those earnings methodologies. So how are we going to quantify surprise earnings? All right, the contemporary literature uses magnitude variables. The original study uses qualitative variables. We're going to use both of those. Ball and Brown use naive earnings, just raw income numbers, which there's no literature support, but they use it, and I'll use it in this dissertation as well. I also use a drift adjustment. I use an analyst adjusted expectation, which I and the literature expect to be the strongest. Literature support for the conclusions. I do a ranking. All right, so which of these variables do we expect to be the strongest, the best way of measuring? Well, we expect analyst adjusted earnings metrics to be the strongest because they are the most specific. We expect naive earnings metrics to be the least reliable because they are just a naive raw number. There's no literature support for that. Drift adjustment is in between. There's some support for it, and it at least accounts for overall market movements. Now, the distinction between magnitude variables and qualitative variables. Well, the contemporary literature uses magnitude variables, so I expected that to be strongest. It turns out that in my research, the qualitative variables were surprisingly strong. So that is going to require some analysis. All right, so variations. All right, so this is how we're going to calculate. All right, so what do I have here? Variations of earnings calculation, rankings based on the literature. So just as I discussed, analyst variables at the top, naive at the bottom. Oh, and then there's a ranking system that I'm going to use in this dissertation for the actual results. And it's going to be a regression analysis. I'm going to say, well, which of these ways of quantifying surprise earnings has the strongest correlation with the full Nikkei 225 sample? All right, assessing meaningful differences. I talked about some studies just say a higher R or R squared indicates superiority. A couple studies try to prove that rigorously. I'm going to try to prove it with the bootstrapping method. Sample data, United Kingdom. This goes into using the FTSE 350 index with the S&P 500 as a control group. Japan, I first try to use the Tokyo Stock Exchange. I find that to be a large pool, a large sample of data, which I thought would be the best way to do it. But it turns out that those companies are not similar in terms of characteristics of company size and so forth. And that is perhaps the reason why the results were more ambiguous as compared to the ultimate results of the Nikkei 225. All right, so the Nikkei 225 requires that firms have certain characteristics. However, one concern I had about the Nikkei 225 is that the IFRS companies would fall into certain categories of industry classification, meaning that only manufacturing firms would choose to voluntarily, or not manufacturing firms, technology firms might choose IFRS, and all the manufacturing firms might say, no, I'm not choosing IFRS. So I had a concern about that, and I'm going to use a proportion difference test to test that concern. Data source, Bloomberg. Okay, Bloomberg is used in a number of the studies, a number of literature studies. It's not commonly used. And I had access to it. I thought it would be a good opportunity to test the ability of analyst expectations in Bloomberg to isolate the surprising component of earnings, and some support there for the reputable qualities of Bloomberg. All right, so that is chapter 3. Moving on to the findings, chapter 4. I'm going to take a short breather here. This has gone on a little bit longer than I thought. I hope you're still with me. But I'm going to take a quick breather, and so I'm going to do a part 1 and part 2 of this video. Let me go ahead and stop recording. Stop.